What a day it was in the stock market. What a day. You know what it takes to get me to buy as many stocks as I bought here today? I bought a long list of stocks here today. We're going to go through all the different stocks I bought here today, why I bought them. Man, was I out there buying here today, okay? Then I want to react to three videos here, okay? This one that went completely viral. The market sell-off will end up looking like a growth scare, says Tom Lee. That's going to be an interesting one. You know it's gotten rough. There's two things you know when the market's in a rough state. One, CNBC starts using graphics like this, market sell-off, and has a artificial intelligence bear, right? And then the other one is if on the local news, they're talking about the stock market. And I had the local news on because I was waiting for the Olympics to start, and I had the local news on while we were eating dinner. And all of a sudden I hear, the bell ringing on the New York Stock Exchange. I looked over and they're talking about the stock market on the local news, and they got like a banker or whatever, like a local Las Vegas banker, like talking about the market drop and whatnot and how far we are from the highs of the S&P 500. And I'm like, when the local news starts talking about the stock market, it was rough out there, right? And then this one, if high-end consumption rolls over, the entire economy rolls over. That's one I'm looking really forward to react to in this video here today, guys. Appreciate you joining me. Thanks so much. Hey, if you were out there buying stocks here today, let me know. What stocks were you buying out there? I'd love to hear from you guys in the comment section. If you bought anything today, let me know in the comment section. I'm going to enjoy reading through it and seeing if you guys were buying anything, okay? Speaking about the comment section, I created this super late last night. I think it was like 2 a.m., something like that. 7 things to do when stocks are crashing. It's a free kind of workshop PDF document that goes all into depth in these 7 things, okay? If you want access to that, I'll put that as the pinned comment today. It's free access. I can email it over tonight or send it via text, however you want it. And bada boom, bada bing. You'll definitely enjoy that. So definitely get access to that. Once again, it's free to get access to that. So what was I buying today? Alrighty, I'm going to start going through it, folks. I mean, you see it. Shop got taken to Chop Shop. Yes, indeed it did. $50 for Shop here today. Now, a lot of these orders, except the ones I'll show you at the end, a lot of these I put in before I went to bed last night. So basically, they just got bought within the first couple minutes of the market being open, which was ideal. You know why it was ideal? And you know why I put those orders in then? The reason I put them in before I went to bed and not, was like, oh, let me wake up and then I'll put in the orders. The reason was when you get many times an insane sell-off, like we obviously had in the Asian markets, what was going on, Bitcoin, Ethereum, like it was a complete panic sell. A lot of times, whatever way you open in that first 15 minutes, that's going to be the best pricing you're going to get because everybody's in such panic mode. They're just running to the exit door and they usually all run right away, right? And so you got to understand the NASDAQ futures last night was down 6% before I went to bed. And so I saw NASDAQ futures down 6% before I went to bed. And I'm like, okay, I'm going to put in all these orders. Like I'll worry about buying all these stocks up right on the open. I'll be asleep. Fidelity will do the work for me. And it did, right? So I put in my order for Shop, got the shares at $50, 36 shares there, right? Then I got Palantir shares at $21. It's just funny, right? I mean, because it's just like people just freaking panic. Like it's insane. The algorithms, oh my gosh, like Japan carry trade, lose your mind. Palantir, I got those shares, $21.68, right? 100 shares there of a Palantir. And for Shop and for Palantir, those are stocks that look like, ooh, they're kind of richly valued, right? When you look on 1000X here. You look at the PE ratios of those stocks, but keep in mind, both these stocks are likely going to be way more profitable than Wall Street expects, which essentially means these PE metrics you're looking at are probably much lower than how they look here. Keep in mind, both these are high growth companies. Both of them are companies you expect to grow top line 20% plus. 20% plus a year for many, many years to go in the future. And both these companies, you expect the bottom line to go up much more rapidly than the top line. So if we're talking 20% on top line, you could be talking 25%, 30%, 40% on the bottom line, if not 50% for these companies. Both of them are actually still very early days. So those are the type of stocks that you look at and you're like, they got to be like richly valued. Not really. Wynn Resorts, I got 25 shares here for $72 of Winning Resorts. I got 300 shares of SoFi at 601. I mean, there was pure panic out there this morning. I mean, that's insane. 601, Somebody told me when I was on my Twitch live stream, which I did like a 4-hour Twitch live stream day, somebody told me that pre-market SoFi was trading in the fives. I'm like, what? In the five? I think that's just panic pricing. I think that's just panic pricing that they were selling at this morning. Like, that's insane. In the fives? And then I'm like, I kind of thought about it. I'm like, is that real? And then I thought, well, if I got shares at 601 when the market was open, I'm sure people were getting shares in the fives in the pre-market, right? Yeah, come on, man. This is clownish, right? Cheesecake. I got 70 shares of cheesecake in the 33s, right? 33.79. Give me as much cheesecake as you can have, man. I'm gonna make a whole lot of cheesecake off that one over time. Nike, I got 31 shares at 71.06. This is just a very easy buy. You know, stocks like cake, stocks like cheesecake, those are very easy buys for me, man. Very easy buys. I don't lose sleep holding these sorts of companies, right? Nike at about a 22 forward P, but keep in mind, we're in a time period right now in regards to Nike where the profitability is about as bad as it will be for the next 10, 20, 30 years. Like, this is as bad as it gets for Nike. Like 2025 and beyond, you're going to see Nike's EPS start going up quite substantially over the next many years, okay, based upon their cost-cutting measures. Additionally, on top of that, you have this dynamic where, you know, revenue will get in a better place in 25 and beyond. Why? Because the consumer will start being in a better place versus a worse place for the first time in a long time. And when I say the consumer, I'm talking about the masses. The masses have obviously been displaced by inflation for 3 years. And those effects of that inflation and the interest rates are really being felt in 2024. It starts to slowly alleviate in 2025, and then it'll get better in future years as far as the consumer goes, right? Now, cheesecake, I mean, come on. Like, all this horrible consumer environment, do people realize Cheesecake just had a new record revenue for this latest quarter versus the previous year? They had a new record net income, $52 million net income. Like, you want to give me Cheesecake at the sort of prices you were giving me at this morning? Okay, fine. Give me, right? It's insane. 33? I'll take them off your hands. Like, people can panic sell, margin sell, will do whatever they got to do. Just give me the shares. I didn't even know I got it at 154. No. I got Amazon at 154 this morning? That's crazy. 25 shares of Amazon, 154 on the panic sell. I mean, my gosh, I didn't realize Amazon got down to 154. I thought like maybe I got a 160 or so. I got some more Estee Lauder. They sold that one all the way down to $91. I got 20 shares there. That's one I just literally started buying within the past week, and that's one I want to build a position in pretty quickly here over this next 3 to 6 months. I think I probably have limited time to build out the position in regards to Estee. I would say that one probably bottoms. I would say insanely high probability of bottoms within the next 6 months, probably bottoms within the next 3 months though. And then these moves I made here, these were later on in the trading day. So this wasn't on the open, but I had some additional money around. There's still a lot of good deals out there. So I bought another $1,200, almost $1,300 in Nike. I bought another $3,600 of Estee Lauder. I bought another $1,700 worth of cake. I bought $1,100, almost $1,200 worth of Palantir. And then I bought over $3,000 worth of Honest. Honest was a big sell-off here today. And I'm like, okay, give me Honest. Like, the fundamentals of Honest will just keep getting better and better and better, right? And so, give me. So yeah, that's what I was up here today. And that's a whole bunch of stocks I was buying. But yeah, whenever the market gets crazy, you're going to see me buy more and more aggressive. Let's say hypothetically, the S&P 500 fell 10% over the next month. You're going to see me buying a whole lot heavier. You're going to see a whole lot of videos about it. I just bought $30,000 worth of stocks. I just bought $20,000 worth of stocks. I just bought $50,000. Like, you'll see more and more. And I moved another $50,000 over today in Ally because I was kind of like preparing for if it really got ugly. I was thinking, like, what if we had some crazy, you know, the Dow goes down 1,500, Dow goes down 2,000, 2,200, like some crazy, like, it sells off at the beginning and then it just gets worse. So I was like, let me move another 50,000 as ammo in there just in case. I'm going to keep that over there for the short term, just in case. If nothing really happens here and the market just bounces back the remainder of this week, I'll move that 50,000 back over savings in Ally, which I think is yielding like, I don't know, 4.3 or 4.4% right now or something like that, right? So I'll move that 50,000 back over. If we get another huge sell-off this week, right? Let's say we have a bounce back day tomorrow, then it gets crazy again Wednesday, Thursday. Oh my gosh, the yen, you know? Okay, you know what we'll do? we'll move that. We'll move a portion of that 50,000 into the market. I'd probably move 20,000 at first. If then we had even an additional sell-off, then I'd invest the other 30,000 of that money, right? And then if we had some more sell-offs after that, another 50,000, another 50,000, and we just keep moving it into the market, right? So, and kind of moving out of savings and moving into positioning, right? So obviously I buy every single weekend, like literally every single Friday I buy, unless the market's closed, and I'll buy on a Thursday or something. So every single Friday I buy, but this is like, we're taking it to another level, right? That's just, you don't get these markets that often. So when you do get these markets, you got to take advantage, man. It doesn't happen that often, right? Alrighty, guys. So let's get into this. Was it? Oh, yeah. I don't know why I have the thing there as well. But anyways. Alrighty, let's get into this.
At Fundstrat Global Advisors, as well as a CNBC contributor. In times like this in the past, it always would help to know, Tom, whether it's a sharp, scary spike down, which a lot of times the other side looks just like it, or people are hoping for that so much that they don't see that it might have longer to go. Do you get the feeling that this is not going to be a major sell-off?
For now, I think it is the former that you described. We have over 3 days, suddenly markets reversed, and Japan down over 20%. And as you're pointing out, the NASDAQ could even decline further. Declines like that are generally symmetric, but you have to watch the VIX. And when the VIX peaks and starts to roll over and fall down, the recovery can be just as quick. I think a lot of this depends on whether financial conditions in the U.S. start to tighten, meaning like, do markets seize up? But with interest rates falling, the consumer's still in pretty good shape. I think on the other side of this, it'll look like a growth scare. But it doesn't mean that
it's
today's
a growth
the bottom.
Scare.
Yes.
It's kind of interesting that it almost looks like the market's showing what the Fed didn't do again. It's almost like once again they're there, but not really ahead of what's happening, and they're reacting, not anticipating, kind of again.
Yes.
On the way up and on the way down.
Yeah.
That's the trouble with the Fed. But remember what the Fed always says. What does the Fed always say? We're going to remain data dependent. That's what the Fed always says. So if they're saying they're going to remain data dependent, that means they're going to keep looking in the rearview mirror, and that's going to be what that's going to be, right?
2 years is signaling that the Fed is behind because 2-year yields have fallen further. But it does seem like, as we look back, a lot more this is because of the surprise hike from Japan and the sort of knock-on effects from there. If that is the primary source of the reaction, I know it's going to be tumultuous for markets, but for the U.S. economy, it's not necessarily bad news. And I think that's why we can balance.
Some of your great and accurate calls have been based on inflation coming in like you thought, much cooler than the market was thinking at the time. I guess the flip side of that is that there can be the dual mandate, there can be labor market weakness associated with why that's happening. Was the asymmetric risk, maybe it wasn't asymmetric, maybe there was a great risk to the job market?
Well, markets don't like surprise. I mean, Friday's jobs report was disappointing.
How far back did they go with revisions down, too? It almost looked like the whole story, the whole narrative that we had is suspect about
That's right. And I think many expected that because, the establishment survey versus household had so many gaps. And so that's kind of converging. But that means markets are waiting until August payrolls report, which is not for 4 more weeks, to really know. But I would say, to me, it still seems like July, even as bad a report it was, is more of an aberration. And I think the trend is still...
Weather, there's a couple of things in it that people...
Yeah, there was almost a record number of people that were having temporary layoffs and people who weren't working due to bad weather. And Texas had a big spike in jobless claims. So it does look like the hurricane had some effect, although the BLS said there was no effect.
On Thursday night, one of the people at your shop said 53.90 looks like a good S&P support. Do support levels mean anything? And you want to give me another one, or is it?
I'll answer that. No, they don't.
Another one to go through.
Well, because it didn't hold, it means that there are other support levels that could be important.
It might not hold.
Yeah, it could not. I think that the VIX is telling us
that.
Gotta
watch the VIX.
Yeah, because it spiked Friday and then it's spiking again today. I mean, the last time the VIX was at this level was April 2020. So for an investor,
I believe VIX at the open was around 60 or something crazy, or 55, something insane.
It tells us kind of where we are, which is we know markets are nervous and they have to unwind, but it's not been a bad time to be thinking that there is a big opportunity on the other side, because once the VIX starts to calm down and markets have already corrected, we know that there's opportunity.
Right. I mean,
knowing that, of course, it's August, as you point out.
You think the VIX high 40s is where it's going to peak, or low 50s? I guess, it's up 100% almost.
Yeah. The VIX may not have a ceiling, because we know in the next couple of days there's also some geopolitical events on the horizon.
And Israel, and Iran, and, we got politics here.
I mean, that's escalating. Some people think, well, that's going to turn into a nightmare this week.
Today.
Or
right. Tomorrow. I mean, we don't want to.
So I think that's why it's all coming to a head this week. I mean, to me, it's a very important week, because we know it's hard to catch a falling knife, as you're pointing out. Support levels are being broken, but mortgage rates are falling. The consumer's in pretty good shape, and the job market, I think it's very unlikely.
But so if the knife is falling, and you like catching falling knives, I know you. So the question is, at what point do you catch said knife?
I spent a lot of time talking to Mark Newton, our technical strategist, over the weekend, and I think that there is a reprieve coming this week. Like, who knows? It could even be today, right? We could open down huge, and then after 11 a.m., we could reverse higher. But I kind of agree with Joe that this is still August, and I think that markets traction really doesn't come back till October. So between now and October, it's maybe a range-bound market at best, but there'll still be opportunities.
And we could call it Bitvidia, basically. I mean, it might as well be Bitcoin. What is Bitcoin? Gold's hitting new highs. Bitcoin, yields. People look for safety. They buy treasuries, they buy gold. People don't buy Bitcoin for safety.
Yeah, Bitcoin is still mostly a risk-on asset. And, there's potentially been lots of liquidations. I think several 100,000 accounts liquidated over the weekend.
So let me show you guys something important here, okay? So if you want to know when is the market close to a bottom when you're in one of these crazy volatile situations, I'll show you a very important thing you can keep an eye on. And you usually know you're close to a bottom. It doesn't mean that exact day you're going to bottom or that exact week, but you're very, very close to a bottom usually. So you want to add this to your watch list, essentially. It's PCE right here. It's the put to call ratio, okay? And what you can see over time is when this put to call ratio goes pretty insane. So when insane is anything above 1, but when it goes above 1.05, you're really getting up there, right? Like the last time we were here was back March 2023, right? We obviously got even higher in regards to that. But that was during SVB, that was a regional bank collapse, and there was a lot of people who were still very, very bearish on the market. So, the put to call ratio went insane during that particular time. Back it up further to that, and you got to go right here, which was December 2022, right? Market had already bottomed at the time. So usually when the put to call ratio goes insane and everybody starts loading up on puts, usually you're rather close to a bottom. It doesn't mean, once again, you're going to bottom that exact week or something like that, but you're getting close to a bottom here. If we see this peak here, we got all the way up to 1.23 put to call ratio. When was that? It's around February, March of 2020, right? So, and then obviously the market bottoms in March 2020. So the moral of the story is the crazier the put to call ratio is, the closer you are to a bottom in the market. And so that's why I always keep it on my watch list. I always keep it on my watch list, because it's one of those things you don't really need to look at it very often, other than when you're going through one of these times and you're like, okay, are we getting close here? Oh, put to call ratio went crazy. Okay, we're getting close, right?
Intensifying this morning, led largely by tech. Want to bring in Dan Ives, managing director at Wedbush Securities. We're looking at the NASDAQ now off about 856 points. Of course, Apple, Nvidia, some of the big laggards. Dan, what do you make of the sell-off? It's a falling knife at the moment. Do you want to catch the knife?
Yeah, I mean, look, for us, we're navigating investors to this white knuckle moment. in terms of looking at the tech names and the winners, what I believe is going to be this AI revolution. Look, there's no doubt that investors over the weekend and today calling, trying to say, is this the end? Is this the end of the tech bull market? I don't believe it is. I believe this is just a massive fear panic that will create the opportunities for NVIDIA to own Apple, Microsoft, Amazon, Alphabet. And that's always been our playbook the last 24 years covering tech.
So when clients call you this morning, are you telling them to buy on this? We'll describe it as weakness, but boy, it feels like it's more than weakness.
Yeah, I mean, we've been basically, I'll say almost table pounding in terms of put the levels, put the names that you want to own that I believe are really going to view this as more of an opportunity rather than as sort of catching a falling knife because of where the growth is. You look at earnings, you look at the numbers. I mean, I'm here actually in Tokyo, and across Asia. The demand is here for AI. That is not leaving despite what we're seeing with this Nikkei sell-off here in the global rout. That's what we're telling investors across the world today.
Dan, I want to put Apple up on the screen for a second because one of the pressure points, in addition to what's happened overnight and then obviously the jobs number on Friday, was the disclosure that took place over the weekend, Saturday, that Warren Buffett has now officially halved his stake in Apple. He's still the largest shareholder in the company. He's been trying to, it looks like, raise cash. He's obviously sold out of other stocks, too, which I think is also weighing on the psyche of the market this morning. But you look, this stock now off 7%. What do you think is behind that sale?
Yeah, look, Buffett was selling a little in 1Q, right? Now, granted, the 50% sale, I mean, that was eye-popping relative, and I think caught everyone's attention. It's going to add to pressure here. It's still his number one holding. He is a huge supporter of Cupertino, number one holding, almost double of B of A. Andrew, our view is if you look at this last quarter for Apple, you look at the guidance, you look at what I view as 270 million iPhones in a window of an upgrade opportunity, an AI-driven upgrade cycle ahead of us. That's reasons to own Apple, not sell it. Now, look, when Buffett talks, everyone listens, no doubt, for good reason. But this is not the time to sell Apple, despite some of the nervousness here. I think this is an opportunity, especially going in to what I view as really a historic upgrade cycle for Apple.
Did you guys see how low NVIDIA got today? Check this out. I don't know if anybody knows how low it actually got. NVIDIA this morning got all the way down to 91. 91 this morning. I mean, it's an insane drop even today at 100, right? 6%. But this morning, somebody was selling their shares for 91. And the other interesting thing, when I look at the big tech watch list, look at the only stock that's green today. The only freaking one, AMD. Whew, I told you guys that setup for AMD is pretty tasty.
Lee, earlier in a sort of macro way about just how things are headed and what may happen over the next month or two. His sense was you're never going to, I don't know, never. It might be hard to get real stability until October, so that even if you think the market rips in the next couple of days.
I love that PayPal is holding 60 plus. Given how insane the market's been, and I think the NASDAQ as of today is down like 13% from the recent peak, right? The fact that PayPal's in the 60 plus, I think bodes very well. When and if, let's assume the market comes back that 13%, right? I think PayPal, all of a sudden, next thing you know, you'll be looking at that and it'll be 70 plus. It's starting to position very well in the market.
After falling
for the first time in
years. It's very hard in the month of August and historically September before you actually know whether you have your sea legs or not come October.
Yeah, look, I mean, I think Tom obviously has great words of wisdom. It is going to be a buckle the seatbelt moment, over the coming months, especially even also going into the election. But if you look at the fundamentals in tech and a soft landing and a Fed cutting environment, I mean, that's the time to own tech. And I get it. The Bears have won over the last week or two, right, after being in hibernation mode the last 18 months. And I get it. But if you look at quality tech, large cap tech, into an AI, what I view as a once in a 40-year cycle, those are names you own here. And I think, that's why we're out here handling through this white knuckle period, not the time to head for the elevators.
Dan, this is, the earnings that we saw, sometimes people nitpick, but in general, pretty good for the Mag 7 across the board. So,
Yep, 100%.
what we're seeing now is probably just some air coming out of the enthusiasm, maybe some multiple contracts a little. What happens if it's a negative feedback loop and actually things start softening up and you actually do get,
It's fair.
not just the multiple side of things, but the earnings side of things? Isn't that, I mean, we're down 10% already in the NASDAQ. Where could that bottom?
Yeah, like the self-fulfilling prophecy. I think the worries there right now unfounded, right? In terms of not just what we saw from earnings, but in terms of what I see, here in Asia, in terms of our checks demand going into the rest of the year and into 2025. Look, that will be sort of a ghost that I think the street will be battling in terms of what could come around the corner. But if you look at the fundamentals here, I mean, they are strong for tech. Balance sheets are strong. And again, it goes into a once in a 40-year type of cycle in terms of spending for AI. There's going to be losers in this. Look at Intel. I mean, if that was obviously a disaster,
100%.
and some others.
Yeah.
But in terms of quality tech, big cap tech, in terms of software semis, those are names you own here, and you don't sell them despite obviously a lot of nerves that are going to be going on across the globe today.
If you told me I had to buy Bitcoin or Intel, I'd go Bitcoin 100%. If high-end consumption rolls over, the entire economy rolls over.
You heard Bob talk about is one of the main causes for the sell-off. And after a red-hot start to the year, Japan's stock market posting its worst day since October 20th, 1987. That sell-off triggering at least part of the global rout that we've seen over the past 24 hours. Kyle Bass is founder and CIO of Heyman Capital Management, warning investors about Japan's economy, specifically regarding its currency and the yen. Kyle, welcome. I feel like we got to stop doing this on nights like this. I'm going to go to Japan in just a second, but I want to follow up on what Steve was just hitting on. The bond market, the bullies in the bond market, they've already been pushing around interest rates. Is the bond market trying to do the work of the Federal Reserve right now?
There's a more technical answer to this, Brian. And late last year, you saw the way the government funds itself go from bonds to bills. And I know that sounds like an arcane idea, but what that did is it released another $2 trillion-ish of liquidity into the market going into the elections. And one can think that these bodies are apolitical, but I can tell you that knowing what's gone on behind the scenes, I can tell you that there have been some political currents going on there. And therefore, now the cries for intra-meeting cuts are coming. Remember, back in 2000, Greenspan in mid-December announced that he was probably going to cut at their January meeting, and it forced him to cut 50 basis points intra-meeting on January 3rd, 2001. So even if the Fed's not intending to cut, here's what happens. They say they don't care about the stock market, but every time one of them talks on television, they go watch what the stock market does as a result of them talking. And so if the stock market rolls over and high-end consumption collapses, which is likely to happen, then you have the whole economy rolling over because it's high-end consumption holding the economy up. And that would make the Harris win less likely. So I think you can expect some aggressive Fed cutting between now and the November election.
Okay, you went there, and
Yes.
so I'm going to follow up with that as well, Kyle. How much? Because the internet mob is out there blaming this on election cycle potential changes, and I will get to Japan in a second. How much?
I knew he was going to have an agenda as soon as I saw those two pillows and I saw all the liquor. I was just paying attention to that. I was looking at the liquor and I was looking at those two pillows and I was like, I know he's going to go somewhere. And sure enough, he did. I freaking knew it.
Any of this move is politically related.
It's so easy to see.
The move so far, Brian, is just the fact that all of the liquidity that was pumped into our markets post-COVID has kind of played its course. You had the Fed increasing its balance sheet by, literally from 4 trillion to 9 trillion. We expanded the money supply by 40% in 18 months, Brian. It's no wonder we had record high stock prices and asset prices. Then we went from funding by bonds to bills, and the Treasury General account and the overnight reverse repo at the Fed put in another 2 trillion of fuel to the fire. And now that fuel's kind of burning off. And now you're seeing things turn. We all looked at each other and said, hey, the Fed raised rates, to 5.5%. Why hasn't the economy slowed down? And it's because the kind of the powers that be were pushing a lot of liquidity into the markets. Well, now that liquidity is no longer here. So, Brian, this is a natural result of an unnatural situation where the Fed has been extremely accommodative and the Treasury and Congress have spent like drunken sailors. And now kind of the time to pay the pipers here. And there's a liquidity gap. I think you're going to see aggressive cuts between now and year end.
You know how markets work, and you get all the stuff, the carry trade. Let's borrow Japan. We're going to buy here. We're going to short volatility. That's all on what you get the mechanics, right? You can rebuild the engine. For 99.9% of people watching and listening right now, it's not what they do for a living. Can you explain to them how these rather sort of obscure moves in Japanese currency can see somebody like in Davenport, Iowa, lose 10% of their investments because hedge funds are doing all these things with currencies and borrowing against them?
I'm not going to blame hedge funds. What's more important, Brian, is the people of Japan. You have a government that had actually taken their country into what I call the Keynesian endpoint. You have a point in time in which you have so much borrowing on balance sheet, and you've got a currency, and you've got this unholy trinity where you're trying to hold your currency in place, you're trying to hold your interest rates in place, and everything in the world is priced in dollars, and the United States exports 50% inflation to you in dollar terms over the last 3.5 years. What do? Well, you have to pretend that you can raise rates, but you actually can't raise rates. Your currency, the Japanese currency, has gone from basically 100 to 160. So if you're a Japanese saver, you've lost 60% of your ability to buy things in that move. And to compensate for that, the Japanese stock market's come up with you. But now you've had the Japanese yen go from 160 to 145 in a nanosecond. And you've had the Japanese stock market drop from 42,000 to 31,000 in a month. You've seen a 25% decline in the stock market in a month. You saw their market go from +6 to -6 in one day today. And that's because, again, like this massive trade is unwinding, but it's not necessarily hedge funds. It's the savers of Japan. It's what Japan does. They go buy dollars and they invest in dollar assets with their money, fearful of the fact that they're going to lose more of their purchasing power in yen. And then when that trade unwinds, they have to panic and close everything out. And that's what you're seeing going on, coupled with the fact that the U.S. economy is certainly rolling over.
Yeah, I wish he touched more on the economy there, right? But the bottom line is, in regards to the yen carry trade, obviously borrowing in Japanese currency, then going ahead and either buying U.S. treasuries with that money at a very low rate, right? Or buying risk assets, which some people do, right? And that's a whole complicated thing. And that's more something big money does. Like, it's not like an average Joe is going and borrow money in Japan and then investing that money and then investing on margin on top of that in the U.S. That is more hedge fund type activity. That would be more big money activity. So he kind of avoided that. Maybe he's got friends in the hedge fund community. He didn't want to offend them, right? But just understand all this is being driven by big money in some of the unwinding of that. It's certainly not retail causing these problems in the market. That's for dang sure. Okay, guys. All right, appreciate you joining me as always. Much love, folks. It's busy time, man. We got earnings season going on with market volatility. Woo-wee. Pin comment down there today. Grab that free one. I made that for you guys last night. 7 things to do when stocks are crashing. There'll be pinned comment down there, and can email it over or text over, whatever. Alrighty, much love and peace.